Good afternoon. I wanted to do a quick video today just to revisit an article that we made back in sort of end of February, start of March, and it was called How to Navigate a Volatile Market. And we've certainly seen one of those since then, with almost record levels of bull to bear market turnaround, followed by really sharp pullbacks in markets since the sort of middle of March the 23rd. So what were some of the things that we highlighted back then that have helped carry us through? Well, point number one, we said keep a bit of perspective. What we mean here is that downturns are normal. Q4 of 2018 seems like it was ages away right now, even though it was actually not that long ago in real terms. But Q4 2018 saw an almost bear market. I think the fall was about 19.5%, something like that. But we quickly forgot about it in 2019 when we saw really great returns from equities. So the human mind likes to play that trick on us, right? Where we remember the negative, try to forget the positive, but as soon as it's all sort of blown out the way and brushed under the carpet, we move on quickly. So try and maintain that little bit of perspective. Downturns are normal and they tend to be quite short-lived. Point number two, selling out of a downturn is not generally going to be a good idea if you are a medium to long-term thinker. So if you do that, what do I mean here? I mean, you've got to get lucky twice. So we saw a little bit of volatility yesterday morning and people maybe were getting a little bit jittery then. Would it have been the right time to sell? Was it the right time to sell in March when again things were all over the place? Well, no. I mean, if you wanted to time that really well, the right time to sell would have been at the February high, right? But we've already now missed that. So you would have had to get lucky that first time, but then you've got to get lucky again for the second time, because remember, we're medium to long-term investors. So when do you buy back in? If you've just seen a 35% fall in markets and you manage to sell just at that right point, do you now have the confidence to put all of that cash back in again? Very few people wouldn't. And getting lucky 2 times in a row is actually really hard to do. Also, if you do sell out, you probably are going to miss some of the good days too, right? If you're not invested, then okay, you don't get the bad days, but you don't get the good days either. And if we look at equity market returns over a long period of time, let's go back to January the 1st, 1980. So we've taken a bit of data from Fidelity here, and they show us that $10,000 invested January the 1st, 1980 would have grown to about $650,000 by January the 1st, 2019. So a 39-year window. But if we had missed just the best 5 trading days in that almost 40-year period, our returns would have only been about $400,000. A massive difference by just missing the best 5 trading days. Normally, the really good days are quite close to when we've seen the really bad days. And in just the same way that you don't know and nobody else knows when those really bad days are going to be, you don't know when those really good days are going to be either. So if you sell, you've got to be prepared to miss the good days too. Okay? Point number 3, the whole system is geared towards you taking an action. Because that's how the system works. That's how the system makes money. Your stockbroker doesn't really care whether you're selling at a loss or selling at a gain. He's still going to broker that trade and make exactly the same amount of money for himself. When you see Bloomberg and you see the adverts pop up, or Yahoo Finance, whatever platform it is that you read your news on, they're all encouraging you to take an action. When for the bulk of us, inaction is going to be the best course of action. Okay? Point number 4, we say this all the time, if you're a lump sum investor, then great, but for the bulk of us, for the majority of people, we actually have to take a little bit of our salary and save it every single month or every week, however it is you get paid, in order to build wealth over the long term. And what we've seen over the last 6 months in particular is that is a really effective way of saving. Not many of us, myself included, would have wanted to put money into the markets on the 1st of March, 1st of April, 1st of May, because we've seen quite big pullbacks from the February high. But those of us that did have captured all that upside and really proven that over time, by just constantly dripping into the market, you get that nice average price of the unit over that 5, 10, 15 year horizon, whatever it might be. So hopefully the article that we published back in February, March was useful for those of you and helped you stay invested and continuing that sort of process. The final point I'd say is that those of you that have felt uncomfortable in the last couple of months, you saw your portfolio going down to a level where it just made you uneasy, you probably need to speak to your advisor there, because it might be that something's not quite right. If your portfolio isn't able to withstand, or is moving too much for your risk tolerance, you need to change something there. You can rebalance, change the asset classes around, include more cash, include more bonds, whatever it is you need to do in order to reduce that level of volatility. Ultimately, yes, we all want to grow our money over time and build our wealth, but we also need to sleep soundly at night during the process. And if your brain just doesn't work that way, it's really easy to turn it around. Okay, hopefully that was useful, and all the best.